This move should not be possible. Silver just delivered one of the most violent price actions in modern market history, and then immediately tried to erase it. In a single session, the metal surged vertically toward $118 an ounce, only to collapse nearly $10 within hours. That contradiction matters, because markets don't do this unless something underneath them is under strain. Overnight, silver traded calmly around 108 to 111. Then, volume detonated. Price went straight up. At the peak, silver was up more than 10% intraday, the largest single-day surge since March 1985. On the screen, the chart didn't curve. It climbed, and then it snapped. Here's why this isn't just a trader story. Moves like this don't stay isolated. They bleed into currencies, savings, leverage, and the real value of cash you hold. When an asset behaves this way, it's not celebrating. It's stress testing the system around it. But here's the part nobody is saying out loud. That reversal didn't end the story. It revealed where the pressure actually is. What happened next looks simple on the surface, but it isn't. The core event wasn't just a spike to $118 and a pullback, it was how fast the market moved from calm to chaos. Silver held steady overnight in a tight range. Then, in a matter of hours, buying pressure overwhelmed the market. Volume surged, price accelerated, and just as quickly, selling pressure slammed into that momentum and forced a violent reversal back toward the 108 range. That sequence matters because it wasn't gradual. There was no staircase higher. This was a vertical move followed by a near-vertical drop. Historically, that pattern doesn't appear in healthy, balanced markets. It appears when positioning becomes crowded and leverage stacks too tightly in one direction. Now, here's the reframing question most coverage avoids. If this was simply a speculative blow-off, why did it happen at a level that lines up with long-term historical resistance? And why did it take 9 consecutive months of gains to get here? This is where the story flips, because when markets behave like this, they're not just reacting to news, they're colliding with structural limits that have been building for years. And to see that clearly, you have to look at the mechanics underneath the price. Here's the claim that changes how this move should be read. This wasn't random volatility, it was mechanical exhaustion. At the peak of the rally, silver wasn't just extended, it was stretched to an extreme that rarely holds. On shorter time frames, momentum indicators were flashing levels normally seen right before forced resets. In plain terms, price ran so fast, that the market physically couldn't support it without cooling off. And you could see it in the tape. As silver pushed higher, volume didn't fade. It expanded. Buyers piled in aggressively at higher and higher prices. That's not quiet accumulation, that's urgency. Then, right near the highs, selling volume hit just as hard. Not gradual profit-taking, heavy, decisive selling. Notice what's missing here. There was no single piece of bad news. No headline explaining the drop, no sudden reversal in fundamentals. The price didn't fall because sentiment turned bearish. It fell because the move itself became unstable. That's how blow-off structures work. They don't need a trigger. They collapse under their own speed. And when a market shows you that kind of internal stress, it's telling you something important. Not about today's price, but about how fragile positioning has become underneath the surface. Now watch how fast this escalates from a technical event into something much larger. Once exhaustion set in, the situation didn't stabilize. It intensified. After tagging the highs, silver didn't drift sideways to digest gains. It snapped back violently, shedding nearly $10 in a matter of hours. That speed is the signal. Healthy markets correct slowly, stressed markets unwind all at once. And this unwind wasn't happening in isolation. It echoed patterns seen at previous cycle inflection points. You've seen versions of this before. In past commodity runs, the most dangerous phase wasn't the rise. It was the moment when vertical moves became normal, when traders stopped asking whether price could go higher and started assuming it had to. That's when reversals stop being corrections and start becoming events. What's unsettling here is how normalized this behavior has become. A double-digit intraday swing in a major monetary metal should be shocking. Instead, it was treated as just another session. That tells you leverage has crept in quietly and expectations have shifted faster than risk controls. But here's where the pressure really builds. Because once volatility like this appears, it doesn't simply disappear. It forces reactions from traders, from institutions, from the structures that sit between buyers and sellers. And that's where the next layer of this story begins to surface. This is where the contradiction becomes impossible to ignore. While prices were exploding higher, the market was quietly setting traps for itself. On the way up, leveraged instruments tied to silver surged even faster than the metal. Paper exposure multiplied gains, pulling in short-term traders chasing momentum rather than value. And that leverage worked until it didn't. As silver pushed toward the highs, the cost of holding those positions began to rise. Margin requirements were increased. Suddenly, traders who had ridden the move up were forced to either add capital or reduce exposure. At the same time, short sellers who had been betting against silver were pushed deeper into losses, turning them into potential forced buyers if price moved any higher. Here's the contradiction that changes how you see the drop. Publicly, the narrative was still bullish. Calls for much higher prices were everywhere, but structurally, the market was actively squeezing both sides at once. Long positions were becoming too expensive to hold. Short positions were becoming too dangerous to maintain. Notice what that creates. A market where the next move isn't driven by belief. It's driven by liquidation. And once liquidation takes over, price stops reflecting conviction and starts reflecting pressure. That's why this wasn't just a pullback. It was the market clearing its throat before deciding who gets forced out next. And that decision doesn't stay confined to silver alone. Then everything started stacking at once. First, volatility didn't cool off. It compressed. Wide swings became tighter, faster, more erratic. A classic sign the market was struggling to find balance. Second, price fell back toward the $100 breakout zone, a level that had just days earlier been treated as unthinkable. What was resistance suddenly had to prove it could act as support. At the same time, sentiment didn't reset. It hardened. Instead of fear, the dominant reaction was confidence. Drops were framed as opportunities. $10 moves were shrugged off. That's not calm. That's conditioning. And then there's the speed factor. These developments weren't spaced out over weeks. They unfolded in hours and days. That matters because fast markets don't give participants time to adapt. Risk management lags, emotion takes over, and mistakes compound. Here's where the tension peaks. Because when volatility stacks like this, leverage, compressed sentiment, rapid price discovery, the market stops responding to analysis and starts responding to force. Now bring this back to you, because even if you've never traded silver, moves like this still reach your life. When a monetary metal swings $10 an hour, it signals stress in the pricing of money itself. That shows up in inflation expectations, in currency confidence, and in how safe people feel holding cash. If you're paid in dollars, this matters. If you save in dollars, it matters more. A market willing to reprice silver this aggressively is telling you that stability is being questioned and not debated, questioned quietly underneath the headlines. And here's the subtle part. These moves don't hit everyone equally. Large players can hedge, institutions can reposition, but ordinary people feel it through higher prices, shakier markets, and the constant sense that everything costs more faster than wages adjust. You don't need to believe in any grand narrative to notice that. You've felt it already at the grocery store, on rent notices, on interest rates that never seem to come back down. If this feels familiar, say so in the comments. Because the market isn't just reacting to numbers, it's reacting to lived experience. And that reaction is feeding back into the system itself, which raises a more uncomfortable question, because the system rewards instability more than stability. Here's the mechanism most people never see. Modern markets are built on leverage, speed, and confidence loops. When things are calm, leverage expands quietly. When confidence holds, risk piles up invisibly. And when something breaks that confidence, even briefly, everything tries to exit through the same narrow door. Silver sits at a strange pressure point in that system. It's small enough to move violently, but important enough to reflect monetary stress. When capital looks for safety, it doesn't arrive gently. It rushes. And when it rushes into a market this thin, price stops being a signal and starts being a reaction. This is why coverage that frames the move as speculation misses the deeper issue. Speculation isn't the cause. It's the accelerant. The real driver is a system flooded with liquidity, trained to chase momentum, and terrified of being last. Here's the unsettling insight. The system doesn't need everyone to panic. It only needs enough participants to lose patience at the same time. Once that happens, volatility becomes the feature, not the floor. And when volatility becomes normal, the next move is rarely small. Because the incentives haven't changed, they've intensified. From here, the path forward splits, and neither option is calm. One path looks like relief. Price holds above the recent breakout zone, volatility contracts. The market convinces itself that the worst is over. Confidence returns just enough for positioning to rebuild. On the surface, that feels stabilizing, but underneath, it reloads the same pressures that caused the move in the first place. Leverage creeps back in, expectations reset higher, and the system becomes vulnerable all over again. The other path is faster and rougher. Support fails, price dips decisively below levels that were supposed to hold. That doesn't end the bullish story. It stresses it. Weak hands exit. Forced selling accelerates. Volatility spikes again, not because belief disappears, but because timing breaks down. Here's the key point. Both paths keep the system unstable. One does it quietly, the other does it loudly. And markets often choose the loud option when too many participants expect the quiet one. What matters now isn't prediction, it's momentum. And momentum is already leaning forward, waiting for the next catalyst, political, monetary, or psychological, to tip it. You can feel it forming. And that's what makes the final question unavoidable. Here's the insight that ties all of this together. This wasn't a story about silver breaking higher or failing at the top. It was a story about a system revealing its limits in real time. When price moves this far, this fast, and reverses this violently, it's not sending a trading signal. It's sending a structural one. The real takeaway is simple and uncomfortable. Markets no longer move to reflect balance. They move to release pressure. And pressure doesn't vanish when a chart pulls back. It migrates, it waits, it builds elsewhere. Silver didn't calm the system. It exposed it. What comes next won't look like a repeat of this move. It will rhyme with it, in a different asset, under a different headline, justified by a different explanation. And by the time it's obvious, the move will already be underway. That's why this story isn't over. It's just changed shape. If you want to understand where this pressure goes next and why it keeps showing up, follow for the next breakdown.